ARM says it can see more than $2 billion of demand for a new AI data center CPU. That sounds like an NVIDIA story. It is not. The more important question is whether ARM just changed the way its entire business model works. Most investors know ARM as the company inside the smartphone. It designs the architecture, other companies build the chips, and ARM gets paid through licenses and royalties. That is the clean version of the story, but the AI data center is forcing a messier version. In its latest fiscal fourth quarter materials, ARM highlighted record revenue, stronger licensing, rising data center usage, and a new product called ARM AGI CPU. The first production silicon was co-developed with Meta, and ARM says it has visibility into more than $2 billion of potential demand over the next 2 years. The simple headline is ARM is entering AI servers. The better thesis is ARM is trying to become both the toll booth and, selectively, the product on the road. ARM's traditional model is elegant because it is asset-light. It does not need to own a giant fab. It does not need to win every end market with its own branded chip. It licenses CPU designs and architecture to the companies that do build chips. Then, when those chips ship, ARM earns royalties. That is why the company can sit underneath Apple, Qualcomm, Amazon, NVIDIA, Google, and many others without looking like a direct competitor in every case. In the March quarter, ARM reported $1.49 billion of total revenue, up 20% year over year. Royalty revenue was $671 million, and license and other revenue was $819 million. That split matters. Licensing can be lumpy because big deals do not arrive evenly every quarter. Royalties are the compounding part. More chips, richer ARM content, and newer architecture can turn into higher recurring economics over time. For years, AI investors focused on GPUs. That made sense. NVIDIA's GPUs became the scarce asset of the AI boom. But a data center is not only GPUs. You still need CPUs to run orchestration, networking, storage, inference flows, and all the background work that makes accelerator clusters useful. ARM's argument is that AI creates more demand for power-efficient CPU cores, not less. Management pointed to data center partners like NVIDIA, Amazon, and Google and said major accelerator platforms are increasingly paired with ARM-based CPUs or ARM technology. That is the opening. If AI workloads need more CPU cores, and if energy efficiency matters, ARM's old royalty model can benefit even when somebody else sells the headline chip. Then comes the part that changes the story. ARM introduced ARM AGI CPU for cloud and AI data centers. According to ARM's investor presentation, the first production silicon was co-developed with Meta, and the company has visibility into more than $2 billion of potential demand over the next 2 years. This is not just another license. In ARM's own framing, the IP and CSS model gives ARM an upfront license fee and per-chip royalty. The silicon model lets ARM sell a more complete chip solution to cloud and AI data center customers. That can expand the revenue opportunity. It also changes investor expectations. A pure IP company is valued for high margins, ecosystem neutrality, and royalty leverage. A chip seller has to deal with supply, packaging, memory, testing, customer support, and product execution. The lazy version of the thesis is that ARM wants to become NVIDIA. That is probably the wrong frame. NVIDIA owns the accelerator layer, the software stack, and the platform economics around GPUs. ARM is not trying to replace that with a CPU overnight. The stronger bull case is more subtle. ARM can win even if NVIDIA keeps winning. NVIDIA's Grace, Google's Axion and TPU ecosystem, Amazon's Graviton and Trainium and other cloud platforms can all increase ARM relevance if more data center compute shifts toward ARM-based CPUs. In other words, the upside is not only from ARM's own AGI CPU. The upside is from ARM becoming harder to avoid across the AI infrastructure stack. There is a catch. Direct chip revenue may be larger in dollars, but it may not be as clean as royalty revenue. If ARM sells complete silicon, it carries more operating complexity. It may also make some customers ask whether ARM is still a neutral platform provider or a future competitor. That is the strategic tension. The royalty business works because the ecosystem trusts ARM enough to build on it. If direct silicon makes ARM look too aggressive, the company has to prove it can expand without damaging the platform. There is also the valuation problem. If investors treat every AI infrastructure company like a future monopoly, even good execution can disappoint. For ARM, I would watch three things. First, royalty growth. If ARM v9, CSS, and data center usage keep lifting royalty revenue, the core toll booth is still working. Second, AGI CPU execution. The $2 billion demand signal is interesting, but supply, timing, and margins will decide whether it becomes real economics. Third, customer behavior. If Meta, cloud providers, and accelerator partners keep leaning into ARM rather than designing around it, the platform gets stronger. If customers start to fear ARM as a competitor, the story becomes more complicated. So the question is not, is ARM the next NVIDIA? That is too simple. The better question is whether ARM can become the AI data center's quiet CPU toll booth while adding selective chip revenue on top. If it can do both, the $2 billion demand number may only be the visible part of the story. If it cannot, the same move that excites investors could make the business less clean than the one they originally loved. Comment the next company you want analyzed, and I will break it down with the same framework.